For decades, the health of Dalal Street was tethered to capital from overseas. When foreign sentiment was high, the market reached new peaks. But the reverse was also true. A sudden wave of foreign panic triggered mass sell-offs, guaranteed to send the Indian market into a tailspin. Historically, the fate of the Indian economy was decided far from Mumbai, dictated by the shifting priorities of traders in Western financial hubs. May 2026 shattered that predictable cycle. Foreign institutional investors, or FIIs, withdrew a staggering 55,963 crore rupees from the Indian market in a single month. This represented the 11th consecutive month of sustained capital flight. Under the old market logic, a withdrawal of this scale over nearly a year should have caused a severe domestic crash. Instead, domestic institutional investors mounted a massive counteroffensive. They injected over 82,600 crore rupees into the market, buying up the very shares foreign funds were abandoning. The expected crash never arrived. This moment marks a pivot in the market's internal mechanics, where domestic strength has finally neutralized foreign panic. This raises a crucial question. Why is foreign capital abandoning the Indian story right now? First, the global AI boom is acting like a giant vacuum for capital. Investors are pivoting toward U.S. semiconductor and cloud computing firms, and India currently lacks a direct entry point into that specific high-tech trade. Second, there's the issue of cost. Many Indian stocks trade at a premium compared to other emerging markets, making them expensive targets for overseas funds. Third, corporate earnings in several key sectors have hit a plateau. Growth has been moderate, failing to hit the high-speed targets that international investors demand. Finally, escalating geopolitical tensions and volatile energy prices are pushing global funds into a defensive posture, causing them to retreat from emerging markets. From an external perspective, India represents too much risk for too little relative gain, sparking a massive exodus of foreign money. But inside the country, fund managers are operating with a completely different set of data and a lot more confidence. Their primary tool for stability is the Systematic Investment Plan, or SIP. Retail investors inject a record 32,000 crore rupees into mutual funds monthly, a steady flow ignoring global volatility. Domestic funds used this cash to buy the dip, executing massive 12,000 crore rupees single-day buys on May 22nd and 25th, providing an immediate floor for stock prices. These domestic managers aren't looking at global AI trends. They bet on India's growing GDP, its expanding manufacturing base, and the government's trillion-dollar infrastructure push. By utilizing this automated retail capital, domestic investors have built a fortress that is increasingly decoupled from the global panic. However, this clash of foreign and domestic capital isn't felt equally across the board. It is creating distinct winners and losers on the trading floor. Large private banks have taken the hardest hit. They have traditionally been favorites of foreign funds, which makes them the very first to be dumped when those funds leave. In contrast, the infrastructure, power, and defense sectors are seeing strong gains. These sectors are heavily backed by domestic money, which is staying put to align with the government's long-term capital spending. The result is a sharp divide. While the large-cap bank index shows a steady downward trend, mid-cap defense and infrastructure stocks are climbing to new highs. With foreign ownership at a 20-year low, the Indian market's narrative is no longer written overseas. Its resilience is now built entirely from within.